Good afternoon and welcome to today's session. All lines are in listen-only mode. This call is being recorded and will be posted on the QC website. If you have any objections, please disconnect now. If you have any questions, please enter them into the Q&A box located in the bottom right-hand corner of your screen. If you have joined using a browser other than Chrome or Firefox, please disconnect and join using one of those. Or if you're experiencing any technical difficulties, please use the raise hand icon and someone will assist you. And finally, we invite you to please remain on the line at the conclusion of the session to complete a brief survey. Your feedback is very important to us. With that, I will turn it over to our Director of Single Family Underwriting, Steve Glancy. Steve, the floor is yours.
Thank you. Welcome everyone to Freddie Mac's Let's QC quarterly webinar series. My name is Steve Glancy. I'm one of the directors in quality control. Here with me today is Dina Marshall, a QC manager, and Lisa Misenchek, a remedy team manager. In a few moments, you'll get a chance to meet them and hear about their topics. As a reminder, in these series, we usually present scenarios that our QC teams see that present unique challenges in our industry. However, this quarter, we will again focus on some of the tools we develop for our clients to help manage their business with Freddie Mac. Dina will present QC steps from loan submission through final decision. Lisa will share how you can use QCA to manage your remedy pipeline. And I will present some trending defects as well as the impact of defective loans on your business. As we continue to strengthen the relationship with our community lenders, our goals for these Let's QC quarterly calls remain: 1, to provide training and guidance; 2, to allow transparency and insight into our quality control loan review process; and 3, to give you useful information to incorporate into your underwriting and QC process. So let's meet the team. As you know, I'm Steve Glancy, Director of Quality Control, and I'm currently in my 12th year with Freddie Mac. I've been in the industry since 2003 with almost all of that time in underwriting and QC. I'm really excited to continue the discussion on the tools we created to help you manage your business. So Dina, how about you introduce yourself and your topic?
Thanks, Steve. Good afternoon, everyone. My name is Dina Marshall. I'm a quality control underwriting manager here at Freddie Mac, and I've been here for about 12 years. Today, I have the pleasure of answering some of the most frequently asked questions that I receive as an underwriting manager, and then walking you through the quality control process from file request to final decision and how you can track those steps in QCA. Lisa?
Hi everyone, I am Lisa Misenchek, and I have been with Freddie Mac in revenue management for 13 years and in the mortgage industry for over 30 years. I will be giving you an overview of how you can utilize QCA to manage your remedy pipeline and also provide some helpful best practices.
Excellent, thanks both of you. Now let's get started with our first topic. Dina, take it away.
Thanks, Steve. Freddie Mac's single-family quality control is responsible for conducting quality control reviews of performing loans and non-performing loans to determine if loans purchased meet the terms of business under which they were delivered. We assess the quality of the loans funded to Freddie Mac to confirm the loan was underwritten to meet the seller servicer guide criteria and/or the seller's specific term of business. Today, I will share with you the path a loan travels from file request to underwriting, which I certainly hope results in Freddie Mac accepting the loan and retaining it. However, if a repurchase is issued, both Lisa and I will discuss the repurchase and appeals process from an underwriting and remedy management perspective and the steps to final decision. Here are a few of the most frequently asked questions that I receive as a manager. We start off with, our loans were sampled. Well, what happens now? Next, we have, what is the fastest way to get my loans through the quality control underwriting process? Then we often receive, what can I do to lower my NAQ or not acceptable quality rate? And then finally, can you share tips that we can incorporate into our process that will facilitate a quicker and better outcome with Freddie Mac quality control? In order to answer the questions, it's really important to walk you through all of the steps that take place after your loan is sampled, all the way to final decision. We start with your loans being selected for sample by our credit, analytics, and reporting team, and we certainly hope the journey ends in underwriting with an accept decision. But in the event you receive a repurchase demand, we'll discuss the steps a seller can take to appeal the decision. This is one of my favorite topics. Knowledge is key, and it's critical to making your way through the process smoothly. It's also a great opportunity for me to share valuable tools and tips that will help you monitor your inventory. If you've had the opportunity to attend our last quarterly webinar on how to deliver a loan file and manage your inventory through QCA, we're going to pick up exactly where they left off. Let's take a look at the path a loan travels once it has been selected for review. We start with our sample, and then we issue a loan file request letter. Once the loans are received, we move to the pre-underwriting step, which allows for imaging and indexing and re-verifications. Then the loan is dropped into a queue for underwriting. If the loan is deemed acceptable quality, the review is closed and the loan is retained by Freddie Mac. As you can see from this chart, a full file with zero missing documentation could be decisioned by quality control in as quickly as 60 days from the time the loan is received. This is the preferred path for both the seller and Freddie Mac quality control. The loan comes in and the underwriter accepts it. The perfect outcome for both parties. However, there are times that additional steps are added to this process as a result of an incomplete or defective loan. I'd like to share the path a loan may travel if it's subject to a missing documentation request, a repurchase demand, a first appeal, a second appeal, and possibly impasse. This chart walks you through every possible scenario in quality control that a loan may travel before a final decision is rendered. If we have an incomplete file at delivery, are missing critical documents, deem the loan defective as a result of the underwriting review, and a repurchase is issued, then the loan enters the appeals process. You can see that this could easily increase the decision timeline from a mere 60 days from file receipt to greater than 7 months if the loan is incomplete and major deficiencies are identified. Our goal in underwriting is to retain a quality loan and to do it quickly. And we know that once you deliver a loan to Freddie Mac, that's the last time you want to touch that file. What we've experienced in the most recent 2 years is a tremendous spike in volume in our industry, which is fantastic. But we've also experienced a spike in incomplete files, missing documentation requests, and repurchase demands. That's what we would like to cure because every single time a loan is opened, it costs time and money for both parties and exhausts resources. Let's take a moment to talk about best practices for loan file delivery. In our first quarter webinar, Henry Chung shared 3 ways to deliver files to Freddie Mac. The first is through Quality Control Advisor. The second is through the Document Management System, or DMS. And the third is Managed File Transfer. Whichever path you choose, and please remember, pick only one path, you have 30 days to deliver the loan to us. This is an area that I remind sellers to please take as much of the 30 days as necessary in order to make sure that you are sending a complete file. There's no benefit in rushing to send a loan in 7 days only to receive a missing documentation request versus, say, taking 29 days to deliver a complete package. Let's take a deeper dive into each section, and I'm going to share some tips along the way. Freddie Mac Credit Risk Analytics and Reporting Team determines which loans or sample that Freddie Mac Quality Control will review monthly. The sample is sent to Single Family Quality Control's central processing team to issue notification letters to our seller servicers, advising that all loans must be received within 30 days. As a side note, if a loan is not received within 30 days, a 15-day extension is granted, but no additional time will be offered. A couple of important steps during the imaging and indexing process is to look for core critical documents. If a core critical document is missing, a missing documentation request is issued, granting 10 days to provide the core document. The loan will not be assigned to an underwriter if the core documents are not in the file. Once the file is received, the next step is to image, index, and perform re-verifications within 25 days. Once the loan file is prepped and ready, the loan is moved to loan decision pending status and is assigned to a quality control underwriter for a comprehensive review. You can track the movement of the loan in Quality Control Advisor. Now, what does Freddie Mac consider a complete loan package? Let's take a quick detour and look at the checklists. There are multiple checklists available, depending upon the review type, and can be found in Quality Control Advisor. We strongly encourage the use of the checklist to confirm you are sending a full file. The checklist in QCA corresponds to the loan review type. A document checklist is provided with each loan file request, and different documents are required based on the review type. Using the correct document checklist can help prevent file rejection and missing or incomplete document requests. The document checklist is a suggested order. It is not required that files are delivered in this order, but it is helpful. Here we have a closer view of both pages for the standard performing or non-performing loan review and required file contents. The list is quite detailed and well organized by section. Sellers committing to using the checklist and delivering complete loan files do see an increase in their accept decision rate, and that is why we continue to encourage its use. Now let's get back to the flowchart, and the next stop is underwriting. The underwriter is required to perform a comprehensive loan review to confirm the loan was eligible for sale to Freddie Mac. The standard review time for a loan is approximately 30 days. However, certain review types may exceed this time frame. An eligible or acceptable loan is one that meets all standards detailed in the Freddie Mac Seller Servicer Guide for program eligibility, credit, capacity, and collateral. If the loan is complete and no deficiencies are identified, the loan is accepted and retained by Freddie Mac. If the loan review results in missing documentation, the underwriter may issue a missing documentation request, allowing the seller servicer to provide the missing documentation in lieu of a repurchase letter. Please be advised that a missing documentation request will only be issued for standard documentation that is customarily in the loan file and critical for rendering a final decision. Some examples of missing documentation are an origination credit report, income documentation, asset documentation, or even HOA documents. The underwriter must pose the question, is this document truly missing, and do I really need it to make a final decision on this loan?
Hey, Dina, quick question. Are the quality control underwriters always required to issue a missing doc request prior to issuing the repurchase demand?
Great question, Steve, and the answer is no. The missing doc request is not an opportunity to recondition the loan, and it is also not an opportunity to be used if a significant or major guide violation has been identified. Let's pause for a quick moment to share two examples of Freddie Mac major deficiencies that would force the underwriter to go straight to issuing a repurchase demand. Let's take a look at two different loans in for review that are identified as Example A and Example B. Example A revealed the following. We are missing pages 4 and 5 from the purchase contract. We're missing the seller side of the CD, missing a flood cert, and we've also identified undisclosed obligations or liabilities on the post-closing credit report pulled by Freddie Mac. The addition of the undisclosed liability results in a debt ratio that not only exceeds the loan product advisor resubmission tolerance of 3%, but also the maximum allowable per Freddie Mac guide for a manual underwrite. Despite the fact that documentation is missing, the undisclosed obligation resulting in an excessive DTI cannot be cured via missing docs. Example A will go straight to repurchase for the undisclosed obligation resulting in an excessive debt ratio, and we will also add the list of missing documents to the repurchase demand. Now let's talk about Example B. For this loan, we are missing the required condo eligibility or HOA documentation, and we've also identified an ineligible collateral type. A review of the appraisal confirmed the subject property is a condotel. A condotel is an ineligible collateral type that cannot be cured through a missing documentation request. Due to the ineligible collateral type, a repurchase demand will be issued for this reason, and the letter will include a request for the HOA documentation. Let's go back to the underwriting piece of our flowchart. The options available to a Freddie Mac quality control underwriter are to accept a loan, accept with a minor finding, or to issue a repurchase demand. If the loan file is complete and a final decision can be made to either accept or accept with a minor finding, the loan is retained. If the loan is subject to missing documentation, a missing documentation request will be issued and the loan review will be placed on hold for 10 days. If the required documents are received and acceptable, the loan is accepted. If not, a repurchase demand is issued for missing documentation. If the full file or the provided missing documentation result in a major deficiency, as discussed, a repurchase demand will be issued. Here are some helpful hints from quality control underwriting. On this slide, you will see an example of underwriter comments provided on a loan transmittal form, which is fantastic. Underwriter comments are very much appreciated. We look for them on each and every loan file, and they do contribute to an expedited review, particularly if the loan has layered risk issues, such as multiple businesses or investment properties. When reviewing the underwriter's comments for this loan, Freddie Mac Quality Control has a basic expectation of receiving documentation to support guide eligibility requirements for a refinance, Social Security and VA award letters, 2020 personal income tax returns to include a Schedule C for self-employment, the COVID-19 requirements for a year-to-date profit and loss statement and 3-month asset statements to support a continuity of income, and confirmation of 4 rental properties, 3 of which were qualified on a Schedule E, and 1 is a recent purchase qualified by a lease. For a loan approved through Loan Product Advisor, I already know that I may be missing documentation based on the comments. Freddie Mac will allow a lease for a recently acquired property that is not reflected on the most recent Schedule E. However, we also require Form 72 or Form 1000 supporting the income reflected on the lease, or the lease plus documentation supporting 2-month receipt of rental income for non-subject property income evaluation. Eligible documents for that include bank statements to evidence rent check deposits, e-transfers of rental payments, or canceled rent checks. This may already be in the file and simply not mentioned in the comments, but I already have a running list of what I'm looking for to complete the review. As a friendly reminder, if the borrower is qualifying with rental income or offset, please remember to review Freddie Mac Guide Chapter 5306 for documentation and calculation criteria. To help with underwriter calculations for employment and net rental income, Freddie Mac offers income worksheets such as Form 91 for each self-employed borrower and rental income worksheets such as Form 92 for rental property. While we do not require the use of Form 91 and Form 92 and will accept calculations documented in any format, we do require them to be documented and on forms that are guide compliant and easy to use. Now let's move forward to discuss the appeals process. If you receive a repurchase demand, you have the right to 2 appeals, but there are rules to follow. Appeal 1 must be submitted within 60 days and must have a cover sheet with a detailed response to our demand in addition to supporting documentation. We encourage appeal submission through Quality Control Advisor. It is the fastest way to submit an appeal for review. Freddie Mac Quality Control strives to respond to the appeal within 30 days. The first appeal is reviewed by the same quality control underwriter that issued the repurchase demand. If your appeal results in a denial, the letter will detail the outstanding deficiencies and also identify if any were cured. The seller also has the right to a second appeal, and it must be received within 15 days. The second appeal is reviewed by a quality control underwriting manager. Again, Freddie Mac Quality Control strives to respond to the appeal within 30 days, and Lisa will discuss the appeals process again later on in this webinar. Steve, I think now is a good time to discuss the impasse process from a director's perspective.
Absolutely. So I'm going to take a moment to discuss impasse best practices and what I expect to see for that review. So impasse, which is our 3rd step in the appeals process. The process is managed by your remedy representative, and the request must be submitted within 15 days of the second appeal being denied. So while it's possible to request impasse after the first appeal denial, we strongly encourage you to utilize all of your appeal opportunities before going to impasse. For impasse, all the documents that are being considered must be submitted. Now, this is really important because the escalation step after impasse does not allow for any new information to be considered. So for impasse, it is not required that new information actually be submitted. You can just strongly disagree with the decision and want further review by a QC director and a possible discussion. Please note, lack of any new information will likely result in us upholding the remedy unless there was some egregious error made by the underwriter and manager. So once the director has completed their review and discussed it with the underwriter or manager as necessary, they will provide the remedy team with their response. While many loans are being accepted at impasse, I do want to bring up a trend I've seen recently. Most of the overturned loans include documentation which should have been in the original file, provided as a missing document, or submitted on any of the prior 2 appeals. This is another area that is a burden and cost on all of our resources. The sooner you get us the documents to cure the defect, the less time and money we both will spend bouncing this loan and back and forth through the remedy process. And you got to remember, the risk that you miss a deadline or forego any subsequent appeals is always present. So if your rationale does not result in an overturn and accept decision, you may work with your remedy representative to schedule a call with the QC director to further discuss. Dina, back to you.
Thanks, Steve. A seller can track the movement of loans requested by Quality Control in Quality Control Advisor. The 7 chevrons identified across the top of the screen allow you to move through the process from sample through appeals and also provide peer comparison details. Please be advised that the NAQ chevron is currently under construction. Freddie Mac is building a more detailed tool for you to track your not acceptable quality details. If you have access to QCA, under the review results chevron is the next step after file delivery to track the current status of a loan in process. The review results chevron allows for easy access to location. As you can see in the summary section located at the bottom of the screen, you can click on the reviews to track all of your loans from file receipt pending to closed reviews in the requested date range. Or you will see that location based on loans in progress, accepted reviews, and remedies. Just click on the number in blue and a loan list will populate, and you can even convert that to Excel. Let's talk about monitoring your NAQ rate. The NAQ percent is determined by dividing the confirmed ineligible loans by the total reviewed in the PL-based sample over the most recent rolling 3 months of reviews that are 98% completed. It's not your most recent 3 months rolling, but your most recent 3 months of reviews that have at least 98% of the loans in a final decision status. An NAQ greater than 3% is deemed high, and please note that a high NAQ rate will materially impact your sample size. In order to lower your NAQ rate, we strongly encourage a thorough pre-closing or post-closing audit process prior to funding your loans to Freddie Mac. Many deficiencies within the files stem from missing documentation, lack of underwriter comments, and missing income worksheets, along with missing documentation. We are confident that many defects can be cured very quickly by your internal underwriting, pre-closing, post-closing, and audit teams. So what contributes to a high NAQ rate? We have identified a spike in miscalculated income. We strongly encourage your entire underwriting team to participate in the online training offered through our training department on how to calculate fluctuating income and how to qualify a self-employed borrower. The smallest details have a huge impact, and here are some best practices. When entering loans through Loan Selling Advisor, please remember that the correct special characteristics codes or investor feature identifiers are very important and may impact a loan being sampled and how the QC underwriter reviews your loan file. Another area that must be accurate is mortgage insurance details. If the mortgage insurance is insufficient, or you enter recourse in lieu of MI, our charter compliance team reports each one of the loans for validation. Incorrect data may result in repurchase if the MI is not compliant with the Freddie Mac Guide Chapter 4701.1, the Loan Product Advisor Feedback Certificate, or the seller's term of business. Please take note that our resubmission tolerance for DTI through LPA is 3%, and if the DTI increases by more than 3% or exceeds 45%, a resubmission to LPA is required. A miscalculation of income or liabilities may have a substantial impact on eligibility. Let's recap our key takeaways. Submit a file with underwriting comments, rental, and income worksheets. Respond to all missing documentation requests within 10 days. Provide a detailed cover letter with your appeal and supporting documentation, and commit to QCA for delivery, tracking, training opportunities, and quality metrics. Now let's take some time for questions.
Thanks, Dina. We will now be taking questions. If you have a question, please enter it into the Q&A box located in the lower right-hand corner of your screen. We've had a few questions come in, so we'll get started with the first one. Why are there 2 missing documentation request processes on the flowchart?
Thank you for your question. The first request is for core, critical missing documentation during the pre-underwriting process, and that's not performed by underwriters, but a team that prepares the loan for underwriting. We have a list of core documents. Examples are loan application, title, an income source for each borrower that must be in the file prior to underwriting reviewing the file. So the team prepping the file they're not underwriting the file. Once the loan makes it to underwriting and a more comprehensive review can be performed, that underwriter has an opportunity to request missing docs that will be much more specific to our underwriting criteria and requirements for compliance.
Okay, our next question is, my company has an income worksheet and a rental income worksheet that we are required to use in lieu of forms 91 and 92. Is that acceptable?
Yes, absolutely. As I mentioned, we do not require you to use our forms. We simply offer them to facilitate your underwriting process. If your company has prepared tools that you are required to use, by all means, please use them, please submit them. I would like to add, though, that we do expect them to adhere to guide compliance for delivering a loan to Freddie Mac. But yes, you may use your own forms.
All right, and the last question that we had was, in the management reports, it no longer allows you to print the reports. Is this something that is being corrected?
So I'll take this one. That's a great question. Yes, there's an issue. I was just notified earlier this week. There is an issue with management reports. We are waiting for it to be corrected. I don't have an ETA on it, but we did not remove that function. It just something in the system broke. So we will fix it, and just please look for that update, and you should be able to print hopefully soon. But I don't have an ETA on it right now.
All right, at this time, there are no further questions, so I will turn the call over to Lisa.
Thank you. Hi, everyone. Now that Dina has walked you through the submission to final decision process, I will be walking you through QCA remedy management, where you can view your remedies that QC issues. First, I would like to start out with letting you know remedy management's mission statement. Our role is to resolve remedy requests, develop and implement remedy plans, and escalate customers who fail to resolve remedy requests in a timely fashion. We also implement new tools to ensure efficient resolution. One of those tools is QCA, Quality Control Advisor. Before going into QCA training, I need to go over an important guide section that Freddie Mac has been enforcing. This is guide section 3602.8 regarding the appeal timelines and requirements. If you receive a repurchase demand, but you feel you can resolve it by providing additional documentation, you may appeal a loan up to 2 times. However, the appeal must include a cover letter with an explanation of all relevant facts concerning the mortgage and an explanation of why the repurchase should be reversed. If you have additional supporting documentation, that should be provided as well. Please note that if you do not provide a cover letter with this information, the appeal will not be logged nor reviewed. As far as the timeline, your first appeal must be submitted within 60 days of the repurchase being issued. If you receive an appeal denial, then Freddie Mac allows a second appeal, but it must be submitted within 15 days of the first appeal denial, and it should contain new information. Any appeals received past the due date or third appeals will not be logged or reviewed. If you feel that the repurchase should still be rescinded and you met the guide requirements, then you may bring the loan to Impasse, but only if it is done within 15 days of your last appeal denial. When opening to QCA, you will see this landing page. As you can see, there are 4 functions: loan file management, remedy management, management reporting, and miscellaneous. We will only be reviewing the remedy management function today. This function provides information on outstanding remedy request. You can also view the loan status, latest actions, and provide real-time comments to our remedy management team. Please also make it a habit to view the notice section on this page. This will let you know if there are any updates or issues with QCA and give you some best practices. Please also note that QCA is always a day behind, and you will see this data as of the date in the right-hand corner of the screen. If you're experiencing issues, there is a technical support phone number at the bottom of the screen too. When entering remedy management, you will see the remedy dashboard. This gives a quick visual breakdown of open remedies with more detailed data available for each dashboard section selected. The top of the dashboard includes totals for the number of outstanding remedies and an estimated amount owed. Below the totals, the information is broken down further by aging buckets of the outstanding remedies. The loan totals, loan count percentage, and dollar amount for the total estimated owed are based upon the filter criteria you select. You can filter the remedy information in the dashboard by clicking Filter By in the left-hand corner. The screen expands to display the filter section. Options include filtering by a remedy source and/or current remedy description. You can select the radio button next to the information you want in the dashboard. If you want to view the loan details, you just need to click on the blue hyperlink. The blue box symbol with the 3 dots indicates you can click on that badge to access a loan level detail in each of the aging buckets. Another tab that should be utilized consistently is the Pipeline tab on the Remedy Management page. This displays loan level details for repurchases and remedy requests. Loans with the disposition of outstanding are displayed by default. However, users may also want to run a query of loans with an issued or closed disposition within a specified date range. This is also a great resource to make sure that no repurchase letters were missed. Your remedy representative's name is also provided in this pipeline report. Something else to note is that all of these reports can be exported to Excel. If you double-click on a loan in your pipeline, the loan detail screen will pop up as shown in the screen. You can view data and navigate among the different tabs, which include Remedy, Appeal, Seller Servicer, Loan, Letter Text, and Upload Docs. On this screen, we show the Remedy tab. Here you can select your customer status from a drop-down box. The most common and useful statuses are Appeal Submitted and Agree to Repurchase. However, you do need to have read-write access to select these statuses or to add comments. This can be obtained through your administrator within your company, and if you don't know who that is, you may call 1-800-FREDDY and they should be able to help. This screenshot shows the Appeals sub-tab in Loan Detail. Here you can see if an appeal has been logged along with the due date for the appeal and if it has expired. If an appeal has been denied, you will see that along with the date of the denial. You will also see the number of appeals that have been submitted. If an appeal decision is still pending, the Open Appeals section will show yes. This screenshot shows the letter text for the repurchase demand along with any appeal denials. This text doesn't show up in QCA until 2 days after the repurchase demand letter or appeal denial is issued. Something to note is that you need to double-click on the loan within the tab for the text to appear. There is also a scroll bar on the right that needs to be utilized to view the entire verbiage. Note that this only shows the verbiage the underwriter adds that cites the deficiencies in the demand letter and doesn't show the entire letter. This slide shows a screenshot for uploading appeals. Whenever there is an outstanding repurchase and you are submitting documentation to dispute the repurchase, you should always select Appeals as an upload type. As stated previously, a cover letter must accompany an appeal submission. Otherwise, the appeal will not be logged. The appeal does need to be in a PDF format and cannot be password protected. This is a screenshot of the document upload log. After submitting an appeal, it is a best practice to review the document upload log and the upload status column to ensure that there were no errors in your upload. This also shows you who uploaded the document and the date of submission. As part of your daily review of QCA, you should be checking here to ensure that all of the appeals that were uploaded were complete. If an error is found, you will need to go back and fix it. Otherwise, the appeal will not be logged. The next slide shows where you can add comments. You may add comments by clicking on the loan in your pipeline and selecting the Add Comments button. A pop-up will display where you can add and save the comment. These will be reflected immediately. However, only the Remedy team can view these comments and not underwriting, so there is no need to put your dispute comments here. A best practice is to utilize comments to advise once you have uploaded an appeal or agree to repurchase. If you have questions regarding repurchase, then it is best to reach out to your remedy contact directly versus adding the question in comments, since these are typically reviewed only once a day. This Reports tab in Remedy Management provides the ability to view and download your month-end remedy reports. There are two types of month-end reports you may pull from here that we will review briefly. They are a month-end summary report and a month-end pipeline report. This is an example of what the month-end summary report looks like. The report gives the number of repurchases, repurchase alternatives, servicing notice of defects, resolution amounts received, and estimated late fees being assessed for the month. This top of the report shows if your remedy metrics were met for the past 3 months and if any repurchases were greater than 120 days outstanding at month end. This is also important to review because monthly late fees start being assessed once a repurchase becomes greater than 120 days outstanding. The goal is to not have any repurchases become this age and to resolve them within 60 days. The month-end pipeline reporting provides a loan level list of your pipeline for the given month. There are 3 tabs: outstanding, issued, and closed report. If you have any outstanding remedies, our team will send a monthly email blast with this verbiage in it. You will also be supplied a list of your outstanding repurchases and the month-end summary report. When you receive this, you should reconcile the remedies and provide updates on anything greater than 30 days outstanding. The remedy contact provided in this email is who you should correspond with. I think we have to go back. Did I miss something? I'm not sure. We did the remedy email blast. I think I need to sum up. To sum this up, here are some remedy management best practices to make you successful. Access QCA daily, utilize the comments section by providing updates, and reconcile your outstanding pipeline often. Now that we've covered how to best manage your remedies in QCA, we'll move on to taking questions.
I apologize, Lisa, there. I think we just got the question slide out of order. So thank you for your ability to manage through that.
Thank you. Okay.
All right, thank you. We will now be taking questions. If you have a question, please enter it in the Q&A box located in the lower right-hand corner of your screen. We do have a few questions for you. Lisa, the first one is, what do I do if I have trouble uploading documents?
First, you should check the messaging under notice on the landing page in QCA for any system issues. If you don't see an issue cited, then you should probably call 1-800 support number that is at the bottom of the landing page.
Okay, thanks. The next question is, in the management reports on the peer comparison screen, will the dates be updated? The current dates showing for the comparison period appear to be outdated.
So I'll have to take a look at that. I didn't focus in on the specific dates there. I believe that data is most likely refreshed only once a month. So that may be while it's showing outdated. But we will take that feedback away, and if there is an issue, we'll get it fixed.
Okay, and the next question, is there a way to get a copy of the actual letter? I know the LTR text shows the same information, but it would be nice to print a new one if needed.
So the letter is sent to a distribution list, emailed to a distribution list that is provided from your company. So if you would like that letter, or if you'd like to change the distribution list, you would just email the SFQC file inventory mailbox and update your distribution list, because we do email all the letters.
Thanks. I don't believe there's a way to reprint the original letter from QCA at this time, because that is actually generated out of a different system, that letter itself.
And the last question I see is, how can we get our email blast address changed as our email addresses change?
So same.
Go ahead.
Lisa, you want to take it?
No, go ahead, Steve.
Okay, it's going to be the same process Lisa just mentioned. If you email the SFQC file inventory, they can go ahead and update your contact information. Unless, Lisa, you know of another way they can do it directly through the system.
Nope, that sounds good.
Excellent.
All right, well, there are no further questions. So Steve, I'll turn the call over to you.
All right, thank you. So now that we've learned about the flow of the loan through quality control and the ability to use QCA to manage your pipeline, let's take a closer look at some common defects Freddie Mac sees, as well as the impact of those defective loans on your business. So here we're going to take a quick moment to discuss the different sample types that Freddie Mac uses in QC. Our PL base is our random monthly sample. You receive this request on about the 10th business day of the month, and it is determined by your volume and your not acceptable quality rate. Then we have our targeted or discretionary samples, and Freddie Mac uses many models based on historical defects from thousands of loans to manage all the different types of risk that we see. Then we have a new type sample called a component-based review, or CBR, and that looks at specific characteristics of a loan. So an acceptable CBR review does not offer the rep and warrant relief because it is not a complete loan file review. These loans can be sampled again for other reasons. However, you will not receive a second file request because we already have the file. And the reason the original CBR review is also out of scope since it was accepted on the prior review. We have a compliance sample. That's what we call a responsible lending sample. All the complete details of this can be found in our guide section 4202. And finally, the non-performing sample, which is determined by specific delinquent payment histories on loans. So your company should also have a random, discretionary, and non-performing samples in your post-fund QC process, all in accordance with guide section 3402.4. So on this slide, we take a look at the defects from all sample types on loans closed from May of 2021 to April of 2022. You can see that income calculated incorrectly is our #1 defect, and I can tell you that fluctuating hourly income earners lead the pack here. It is important when looking at income for a fluctuating earner that you make an accurate calculation. Year-to-date income can look to be supported as non-fluctuating if the calculation's not done right. So we'll dig into an example of that at the end of this section. Missing or insufficient income docs, along with income not stable, they make up over 5,100 of the 8,347 top 5 defects. So that's a whopping 62%. And another 13% were in the COVID income space. So you can see that 75% of our top defects are all related to income. So Freddie Mac does offer a variety of training resources on income, along with guide clusters that we discussed in our last webinar. So for a quick comparison, this slide shows a side-by-side of the defects year over year. You can see the appraisal flexibility violations did increase in number as we continued through the pandemic. However, the volume and frequency of income-related defects increased even more. Also, the total number of defects in the top 5 increased from 3,306 to 8,367. That's a 253% increase in the number of defects Freddie Mac's finding on loans delivered to us that are resulting in remedy. I know you all are feeling this in your sample. Hopefully you've been able to identify and correct this through your critical pre-funding and post-closing QC process. So this slide here, it shows that the previous slide showed the defects in all of our samples. As we saw in the first slide, Freddie Mac has multiple sample types. Since PL base impacts your sampling the most, I wanted to show a chart with the side-by-side year-over-year defect comparison for that sample type only. The PL-based sample drives what we call your not acceptable quality rating, or what Freddie Mac refers to as your NAQ. The NAQ is the number of defective PL-based loans that result in remedy, or a remedy alternative, divided by the number of PL-based loans in that specific period. Again, you can clearly see income is the leading defect in our PL-based sample. The missing income defects have increased 221%. QCA offers you the ability to drill down on your missing documents, and we do expect our sellers to use this information to identify gaps in their process or their systems to prevent missing docs. Missing docs are really timely and costly for all of us, but we'll cover that a little bit later as well. All right, so before we dig into the missing doc and the NAQ impact along with that scenario, let's just touch on one final item. So what makes a loan decision final? There are 4 ways a loan decision in QC can be final. The QC analyst accepts the loan, either outright or after a missing doc is received. The QC underwriter rescinds an appeal. The client agrees to repurchase the loan, or an alternative to remedy is granted by the remedy team and accepted by the lender. All right, so let's dig into the PL-based sample a little more before we discuss the impact of the defects on your business and that fluctuating income scenario. So I mentioned earlier, and then we'll open it up to questions. So our PL-based metric, it's determined by 2 things, your volume and your NAQ rate. Your volume will determine the confidence level our sampling methodology needs to achieve. The higher the volume, the larger the confidence level needed. Your NAQ rate has the largest impact on your monthly sample. So the monthly sample is a moving target, and it is decided on the 10th business day of each month, but it's based on the most recent 3-month period that is at least 98% complete for your PL-based random loans. So our QC team remains very, very current on the PL-based sample, as this impacts your business as well as key metrics for us. However, the resolution of remedies is the biggest holdup in completing the look-back period. So our remedy and QC teams have made some changes and are working diligently to move appeals through the process as quickly as possible. However, this means that your elevated NAQ rate could linger a little while if we cannot resolve the remedy loans timely. So here, let's take a look at the missing docs and the impact of defective loans on your business. So this slide here shows that impact of missing docs and the defective loans on your business. And if we start at the top in the middle, we all experience stress from volume, the lack of resources, those ever-changing requirements. And volume may be slowing down and the refi boom subsiding, but we need to remain vigilant that we're originating high-quality loans. As we move clockwise to the right, the stress has led to incomplete files being delivered. And as we keep moving down, those incomplete files lead to a missing doc request from Freddie Mac, which requires a response from you, and it creates added time, cost, and strain on some already stressed resources. So if it's not resolved, then it leads to more repurchase requests. Again, requiring a response, adding to the strain on our resources. And many missing doc requests are responded to. However, not all the responses include the documents that were needed.
And Steve, quick question. How long do the lenders have to respond to the missing doc request?
Great ask, Dina. Currently, we do give the lenders 10 days to reply to the request before the remedy is issued. So now as we keep moving along that path, we see the higher repurchase rates lead to an increase in your not acceptable quality rating, which directly impacts the number of loans we sample for your performing base random sample. And finally, that higher sample will again lead to added stress, costs, and time. So what I see is that all these bubbles have something in common, people and processes to manage. The impact will become compounded as the volume piles up or the quality degrades. Freddie Mac does believe one of the root causes is incomplete loan files at origination or delivery, and that addressing that through your own internal QC process will help relieve some stress and free up some resources. All right, so now let's take a look at that scenario. So this excerpt from Guide Section 5303.2 defines base non-fluctuating income. Few key points to consider with base non-fluctuating is there's an agreed upon number of hours. So the borrower, they don't have to work 40 hours, but the minimum number of hours being used to qualify must be consistent every pay period and fully supported by the year-to-date income. Our example will show where the mistakes are typically made in this analysis. Also, the minimum number of hours used in qualifying must not fluctuate between pay periods. So next in same guide section 5303.2, it defines fluctuating hourly employment earnings. When the number of hours the borrower works fluctuates between pay periods, then the income is typically fluctuating. An important point here is that the number of hours worked can exceed the number of hours the lender is using to qualify. For example, we got a lender who's using 36 hours each week for a nurse, but that nurse actually works, 36 to 39 hours. The 36 hours can be considered base non-fluctuating for qualification purposes. However, any amount over that used for qualifying would be considered fluctuating and would have to meet the guidelines requiring a more historical analysis and average. So let's look at the example. We got a borrower, they're paid $16 an hour, which is $2,773 per month if they work 40 hours a week. The pay stubs we reviewed showed they're paid every Friday for hours worked the prior Monday through Sunday. So looking at that top right calendar, the April 16th pay stub included income earned Monday, April 5th through Sunday, April 11th. It is important to note that 2021 was particularly challenging, as the second calendar below it shows the first Friday of the year was January 1st, and any year-to-date income on January 8th or later would have actually included 10 days of hours worked in 2020. So the file had two pay stubs in April showing 40 hours. The lender used 40 hours times 16 for 52 weeks. Pay stubs showed no additional sources of income. The year-to-date income was $9,856, and if you use the 3.53-month average through the 16th of April, you get 2,792 hours, or $92. So if you use the 3.37-month average through April 11th, their last hours that they worked, that yields monthly income of $2,924.
So, Steve, wait, both of those amounts exceed the monthly income used in qualifying based on 40 hours a week, and there were no other sources of income?
That's right, Dina. And that was your first red flag. If you start with the pay date of April 16th and count back to January 1st, you get 16 weeks of pay. This is the denominator you should be using for your calculation. So here, these first three bullets kind of recap the income used in qualifying of only 2,773, year-to-date income on the pay stub, as well as the average that was used by the lender. So again, in looking at the calendar, you can quickly surmise the pay stub dated April 16th with earnings through April 11th included 16 weeks of hours worked. When dividing the year-to-date by 16, you get only $616 per week, or only 38.5 hours at $16 an hour. So that's only $2,669 per month. And it does not support the borrower as a base non-fluctuating income earner working a consistent 40 hours per week. Let's remember, to be considered base non-fluctuating, the year-to-date income must fully support the hours do not fluctuate between pay periods.
So, Steve, what exactly did the lender do wrong here?
That's another great question, Dina. The lender utilized the wrong denominator, and they included income that was earned in 2020, but they did not factor in the time when that income was earned. The denominator of 3.53 only included January 1st through April 16th. The $104 difference did make this loan ineligible, as the DTI exceeded 45% and the LPA tolerance. So the correct denominator would be 3.7 by using April 11th as the last day worked and the stub and adding the 10 days that they worked in 2020 for that year-to-date income. 21 divided by 30 is 0.7. So it's extremely important to be very careful when calculating year-to-date income on hourly borrowers to ensure the accurate analysis has been done. Borrowers paid biweekly can cause even larger discrepancies, as that time excluded would likely include up to 17 days of income. So some key takeaways. Income defects are on the rise and they are still leading our industry. Your NAQ rate is the most significant factor in determining your monthly sample. Poor quality originations and deliveries can result in lost time and money, and calculating income accurately is extremely important. So now let's take any questions we have.
Thanks, Steve. We'll now be taking questions. If you have a question, please enter it in the Q&A box located in the lower right-hand corner of your screen. We do have a question, Steve, and it is, does Freddie Mac look at the risk attributes of a loan when making a decision in QC?
You know what, we get that question frequently, and yes, we do consider the risk attributes. However, all of the data must still be accurate. There are some hard stops defined in our guide around DTI tolerances, so that regardless of the FICO, the LTV, length of employment, housing payment change, or their credit history, if that DTI exceeds 3% or crosses from 45 to 46, that LPA must be rerun with the correct data. Also, it's important to note that above 45%, there is no 3% DTA tolerance in LPA. So we do look at risk characteristics, but we do have some hard stops in the guide that we cannot overcome with just other low risk attributes.
All right, great. We don't have any further questions, so I will turn the call back over to Dina.
As a reminder, for additional information, we encourage you to take advantage of the training and resources available from the Freddie Mac Learning Center. The Customer Call Center provides seller servicer support Monday through Friday at 1-800-FREDDIE.
And please visit the Freddie Mac single family website at sf.freddie.com and stay current with resources there, including the Single Family Seller Servicer Guide at guide.freddiemac.com. You may also find additional guidance and information, including the recordings of our Let's QC webinars on the Single Family Quality Control page hyperlinked above.
All right, that ends our portion of the presentation for today. We hope you enjoyed the webinar and found it useful. I want to thank all of our clients who joined us today for the call and let you know how we appreciate your business. As a reminder, if we did not get to answer any of your questions, we'll get back to you directly next week. Now you'll see a brief survey on the right side of your screen. If you could please answer these questions, your feedback is very important to us. Thank you and enjoy the rest of your day.
Thank you.
Thank you.
Thank you to our presenters, and thank you for joining today's session. As a reminder, the recording and supporting resources will be sent via email as well as made available on the QC webpage. Enjoy the rest of your day. Thank you.